I've asked Frank Beck to come up and speak some, because basically he's been attacking that problem, and he's been doing it for me. And one day he's in copper, and by the way, you know, he rolls into different commodities, different currencies, long, short, depending on the situation. The overall background is the emerging markets are emerging, the developed countries are going down, the situation says don't be in debt, favor real return assets in a growing currency, in a currency that's appreciated. But anyway, I asked Frank to come address that issue of what you could do with your funding. Thank you.
I promise I'll only take a few minutes longer than Lou did. Now you see what I get to enjoy every Monday. Actually, Lou's liability insurance company asked me to come up here tonight because they were afraid of anyone after that presentation going home, slicing wrists, drinking heavily. I love talking after Lou because almost anything I say you're going to find uplifting. I don't want to take a lot of your time. It's getting a little late, but I did want to just address a couple of things. And one thing was mentioned earlier is that, well, let me give you a quick bit of background. I met Lou, or Dr. Spellman, about 5 years ago. He had an interesting way of interviewing money managers. It was pretty in-depth. It started with phone interviews, request for phone interview, then a formal phone interview, which he whittled down to 3 or 4 of us that he did personal interviews, and then called me back about a week later and said, hey, you won. And I really did, because actually at the beginning of this year, after a long relationship and talking markets and macroeconomics for the last 5 years, and that puts us through some pretty good times, some pretty rough times that we got to go through and see how those went. And actually they went pretty well, probably why I'm here. And now we're going through a time that Lou just described to you as pretty darn near the end of the world. So how do you invest in it? That's something we are going to talk about. We have a couple lectures coming up, one at Austin Country Club, I forget, is that October 5th? And basically what we're going to talk about is, or what we're doing here is, in my firm, Beck Capital Management, the intent of the company in its beginning was I wanted to bring institutional investing to the retail environment, and we can do that with accounts basically as small as about $500,000 we can do institutional style investing. And but just to give you a quick bit of, a few things to think about, and then we'll get out of here and go home and hopefully just have the one scotch and reflect. But a couple things going on. Dr. Spellman mentioned that you want to look at foreign markets, foreign currencies. Well, I couldn't agree more with him on that. An obvious demographic. When I was growing up and talking to my father, who was in the money management business as well, he told me a simple rule was just look at the baby boom generation. There's 75 million of you. He started buying Gerber baby food, or Gerber stock, and Gerber baby food. And then as we got a little older, it was US Kids and Schwinn bicycles, and then in the 70s it became real estate. And so on, and probably in another 10 years it'll be golf balls. We hope. Depends. Thanks. Speak for yourself, Bruce. But for right now, a couple areas that you can look at yourself, besides the obvious. I mean, gold, I get asked about gold all the time. I wrote an article of my predictions for 2010 for Forbes. They asked me to comment on currencies and such, and of course gold being kind of the real currency. At the time, gold was $1,040. That was at the December of 2009 when we were writing these. And they wanted us to be bold predictions. So I said, well, gold will be $1,500 by the end of the year, by the end of 2010. And they asked me to back that up a little bit. I said, no, let's go with $1,500. It ended up about $1,480. And, you know, part of that is, you know, I'm asked all the time, because I've been a long-time believer, you know, probably 7, 8 years now, we've been buying gold and holding it as a position in our portfolios. And I don't want to be classified as a gold bug. I'm not a bug on anything. I believe that sectors rotate, just the economy cycles, and you got to cycle with it. It just happens to be that just like the NASDAQ lasted a long time, it lasted probably 15 good years if you count from about 85 to 2000. Gold's lasting, and it'll continue, in my opinion, to last until the government start getting all this stuff right. Either we're going to get a currency that's backed by something hard again, because what we have is gold has been around and has been a currency for 4,000 years, maybe 5,000 years. It's been a currency. Fiat currencies, unbacked paper currencies, backed by nothing but the good faith of the taxpayers. They've been a 40-year experiment, and it hadn't gone too well. Because 40 years ago, we went off the gold standard, and it didn't really hurt things. You didn't see it so much. You saw it early when we went off the gold standard. But then we had the 80s where the stock market, bond market, everything was good in the 80s and 90s. And it wasn't a big problem. But now we're sitting here faced with giant debts, giant deficits, and like Dr. Spellman was saying, we've got these huge unfunded liabilities that when you say 15 trillion of funded liabilities, 60 trillion of unfunded liabilities, that 60 trillion has some pretty bold assumptions in it. It's probably, realistically, I would call it more like $110 trillion of unfunded liability, because I don't believe we're going to have an average of 4% year in, year out GDP, and that's about what it takes to get to just 60 trillion. So that's why gold is going up, and I think it's going to go up until we see something done with currency, either worldwide. I don't know what the answers are, but it's, and one other point on that is I do believe this supports gold also, but I do believe, like the doctor was saying, is that printing dollars is a lot easier. Even the ECB, the good news is, yeah, 25% of the bank's assets may be in euro sovereign debt, but you know, only a small portion of that. This is the point counterpoint we go through on Mondays, because Lou, starting at the beginning of this year, and Dr. Spellman to some of you, has been on our investment committee for our firm. I asked him at the end of last year to join us, and he graciously has. And so every Monday morning at our investment meetings, there used to be a big discussion amongst all of us. Now it's pretty much everyone else sitting back with their mouth open, you know, listening to Lou and then me trying to pump them up. So it's, we got this thing like they used to have on Sunday mornings, and it was point counterpoint or something, you know. And so, but it's, you know, we get to look deeply at what's going on and decide where we're going to place our money. One of the areas that I think is still around that hits with all these things where you can make some money, it's not overly complicated, but instead of buying bonds denominated in US dollars, as a matter of fact, all the bonds that you're holding, if you're holding bonds, any debt right now that's denominated in US dollars, it's at the highest price right now that it probably will ever be. I would absolutely sell anything that's not going to mature very quickly because the dollar is, even though we get these brief things where everyone flees the euro and everyone was fleeing towards the Swiss franc, Now there's, the Swiss came out and said enough of that. We're going to come in and step in as a central bank ourselves and control that. So that meant the investment in Swiss francs was over with, and so we left. You know, we don't own any Swiss francs since the day they came out and said that. It doesn't make sense. And so for a short period of time, you're going to see, like right now, the dollar is the recipient. Gold still, to some extent, the recipient in waves. It's trying to consolidate this big move it has recently taken up. But I still liken the dollar is, I mean, because we've just now, you've seen the wave come in. The 10-year U.S. Treasury dropped all the way to 1.91%. A few weeks ago when we had a wave of money come into the country, the 10-year Treasury got all the way down to 1.84% for a day. I mean, 1.84% for 10 years on a currency that has devalued by an average of 4% every single year. As a matter of fact, not just an average of it, there's only been a few years where we've devalued the currency by less than 4% in a year over the past 40 years. So if you're devaluing your currency by 4%, you're earning 1.9%. You know, that's what I call a safe way to go broke slowly. And, but what you can do is you can take those bonds and buy bonds denominated in foreign currencies, strong currencies. Take the anything from as close to home as the Canadian dollar, the krona, go to the Norwegian krona. Australian dollar is you know, settled back in. Last year was a great time. We owned some, as a matter of fact, General Electric bonds denominated in Australian, in the Aussie dollar. And the Aussie went up 30% against the US dollar last year. So that was a boon from both the fact that it was paying us 7% coupon, plus we had 30% appreciation in the currency. So it's the kind of thing I don't expect to get those things often, but you can expect to get 5 and 10% appreciation in a lot of currencies. And I think the krona is a good one. There's quite a few of them out there. And of course they cycle as well. But even right now, there's some high dividend companies I mean, companies, good companies with steady revenue that have high dividends. And a lot of them, I'll give you one you might not think of that would fit this bill, but Intel, which has a 4% dividend now, last year they made over 75% of their revenue came from sources outside of the United States and Europe. So we're not dependent on the consumers of the United States and Europe. I don't want to be dependent. If I'm going to start a new company right now or invest in a company, I'm certainly not going to invest in one that's US-centric or European-centric. I mean, our consumers are going to struggle for a little while. Hopefully we'll get through these things, but you know, I'm talking about investing today. And so the obvious group is the Chinese consumer. They're not the only one in developing market that is a growing middle class. They have over 300 million people in their middle class. They're adding 20 million a year to the middle class. The entire group is migrating, and their income is migrating upward. So another 20 million keeps coming in. Well, it took us 20 years to build a 75 million strong middle baby boom, and they're building a baby boom every 3.5 years. So just and they're all adult middle classers already. We don't have to wait for them to grow up and their parents to be buying them things. So that's a good group to look at, companies that are selling things to them. It's a appreciating currency. I think you can count on that currency to appreciate. As a matter of fact, they're appreciating it for the last year. It's appreciating now at a little bit faster clip than it was 6 months ago. I think it'll start appreciating at about 7.5%. Last time they appreciated it for 3 years until the financial crisis. It appreciated 5% the first year in 05 to 06. That started in May of 05, then 7.5% the second year and 10% the third year. Those are the kinds of things that I guess we'll be talking about. And we've got someone outside. If you'd like to just give an email address, your name and an email address so you can do it quickly, or you could even email Dr. Spellman and tell him that you'd be interested in coming to that. We'll get you an invite to it, but we'll both be talking about the markets and how to invest in this market. And, just in the interest of time, I'm going to call it a night. Thank you.
All right. I know there's going to be questions from this group. Here's the mic if anyone wants to raise their hand.